For the fourth quarter here when it comes to EMs? Have we found that line in the sand when it comes to equities as well as the currencies?
Good morning. Well, I certainly think there's a case for still looking at emerging markets more closely, even if it's on a differentiated basis. Absolutely, we could see the numbers in terms of China economic data start to improve as some of those targeted stimulus measures do enter the fray, and the market will look at that positively, but more neutral on it overall because there are those risks around whether the US dollar will depreciate further. We still have a lot of central bank tightening to come through on some of those current account deficit countries, which could dampen down domestic demand. And then there's also the scope for the oil price to move higher, again impinging on some of those current account deficit countries and hurting consumption overall. So right now it's more of a balanced view on emerging markets, but at today's valuations I'd say there's definitely side for upside to growth in EM assets over DM assets, more so given the relative valuation argument.
Yeah, we've been talking about this JPMorgan report that came out over the weekend. I know your colleague John Norman wrote it, but it was interesting what he said. It was that part of that China stimulus that's coming through is a weaker currency, and that's where it's going to have ripple effects on not just the FX markets, but also equity markets as well. So do you think that this policy support at the end of the day could actually spark the opposite effect?
Well, I think the change in the currency is going to matter most for Asian economies. If the Chinese yuan's moving lower, obviously that's very bad competitiveness for the rest of the Asian economies, and obviously sees then have to try and think about their currencies going lower at a time when many of them are trying to defend them and actually tightening rates to hold them up. So it does become a bit of a dichotomy. I think that the stimulus measures from China are more viewed as a positive sentiment to saying the growth story in China won't roll over as it tries to offset a lot of these trade negatives. However, it is about that depreciation being more palatable in terms of the smaller depreciation in the yuan that does come through as China looks to that to try and offset some of those trade measures. But a significant depreciation in the currency would obviously be very negative. That's not our base case, and I believe that's what the investment bank were writing about in that report, that we will likely see that depreciation to offset those trade measures, and it does create additional concerns about EM assets. However, it just again highlights that need to be a bit more differentiated when we think about the areas of opportunity within emerging markets, whether it be by country or by sector. And I still think for a long-term investor at these valuations there are scope there. It's just that I expect that volatility to be higher while we have that uncertainty around the US-China trade agreement, while we have that uncertainty around the oil price and how much it can move higher in the near term. And that's not quite palatable for many investors right now.